$200 billion.
It's a number that, I mean, it just stops you in your tracks.
It does. And just to be clear for everyone listening, that isn't the GDP of a small country.
Well, it could be.
It could be, yeah. But it's the projected capital expenditure, or CapEx, for Amazon. In 2026 alone, one company, 1 year, $200 billion.
It is staggering. And it perfectly sets the stage for what we're doing today. We're calling this the Iron Financial Report. We've taken this massive stack of earnings reports, 8K filings.
All the good stuff.
All the good stuff from Q4 2025 and early 2026.
Yeah.
Everyone from Amazon and Alphabet to the chip makers like AMD and NXP, and we are going to break it all down.
This is basically Wall Street meets Main Street.
Oh.
We want to separate the AI hype, the marketing buzzwords, from what is actually happening in the bank accounts of these companies.
Exactly.
Because usually when companies spend money like that, there's a very, very specific reason.
And the story that emerges from these reports, it's not a single straight line. It's messy. You have some companies sprinting at speeds we have arguably never seen in financial history.
And others that are, well, let's call them joggers.
Joggers is a great way to put it. They're just trying to get back in shape after a rough year.
So let's start with that number I threw out at the top, Amazon. $200 billion in CapEx. For anyone who's not familiar, CapEx is basically money spent on physical assets, buildings, equipment, infrastructure.
Right. It's not salaries, it's stuff.
It's stuff. So why is Amazon spending a nation-state's worth of money on stuff?
Because they are terrified of losing the future. If you look at the management discussions section of their report, the tone has just completely shifted. For the last couple of years, it was about planning for AI or maybe testing some models.
Right, yeah.
It is all about heavy metal. They're building the physical backbone of the next computing era. Andy Jassy, the CEO, specifically cited seminal opportunities in AI chips and robotics.
So this isn't just more cardboard boxes, warehouses, and, electric delivery vans.
Oh, far from it. This is data centers. This is power plants. This is custom silicon. And Amazon isn't alone in these astronomical numbers.
Oh, I'm sure.
Take a look at Alphabet, Google's parent company. They just crossed a massive line. For the first time ever, their annual revenues exceeded $400 billion.
$400 billion in revenue. That is so hard to even visualize.
It is, and it's driven largely by cloud and search growth. So you have Amazon pledging $200 billion in spend to build the infrastructure.
And Alphabet is bringing in $400 billion in revenue from using and selling that same kind of infrastructure.
Exactly. The scale here is effectively rewriting the rules of corporate finance. We're seeing the gold rush phase transition into the, we call it, industrialization phase.
But here's where I want to push back a little. We hear these numbers, $200 billion, $400 billion, and it sounds like the entire tech sector is popping champagne. But when I look through the stack of reports you sent over, that didn't seem to be the case for everyone. There were some pretty sober notes in there.
You picked up on the divergence. That is the second big theme of this cycle, the multi-speed recovery.
Right. It feels like we have sprinters and joggers.
That is a great way to frame it.
Yeah.
The sprinters are the companies directly tied to that massive infrastructure build-out we just talked about. Take Palantir, for example.
Palantir has always been a bit of a polarizing company, for sure. But their numbers this quarter were aggressive.
Aggressive is putting it mildly. Their CEO, Alex Karp, dropped a phrase that I think perfectly captures their current mindset. He called the company an N of 1.
Meaning there's a sample size of 1?
Nobody else does what they do.
That's the claim, at least.
It is. And the financials, they kind of back it up. We need to talk about the rule of 40.
Okay, help us out here. I see this metric all the time in SaaS reporting. What exactly is the rule of 40?
It's a standard metric for software companies to balance growth and health. You take your annual revenue growth rate as a percentage, and you add it to your profit margin, also as a percentage.
And if the combined number is over 40?
You're considered a healthy elite company. Most companies struggle just to hit 40. You might grow 30% but have a 10% margin. That's a 40. You're doing great.
Okay. So where did Palantir land?
127%.
Wait, 27? That seems mathematically impossible. You're saying they are growing massively and keeping a massive amount of profit.
Precisely. Usually you have to sacrifice profit to get that kind of growth, right?
Yeah.
You have to spend on marketing and sales. Palantir is doing both simultaneously. It suggests they're breaking the standard financial models because demand is it's outpacing their cost to deliver it.
Wow. Okay, so Palantir is sprinting. Who else is in that category?
Supermicro. If you want to see what a vertical line looks like on a revenue chart, look at them. Their net sales jumped to $12.7 billion in the second quarter.
12.7 billion. Okay, contextualize that for me. Where were they before?
The previous quarter was $5 billion.
They more than doubled in 3 months.
Yes. Sequential doubling. That is hypergrowth in hardware. It's fueled entirely by the demand for data center building blocks. Basically, if Amazon or Google wants to build a data center fast, they call Supermicro.
So those are the sprinters, but then we have the joggers. I was reading the report from Microchip Technology, and the vibe was different. Not bad, just not doubling in 3 months. Good.
The joggers are the companies further downstream. Microchip Technology and NXP Semiconductors. These are the guys who make the chips that go into cars, washing machines, factories.
The real world.
The real world. And the real world isn't growing at 127%.
No.
Steve Sanghi, the CEO of Microchip, was very transparent. He described the market recovery as developing more gradually than anticipated.
Which is polite CEO speak for, it's taking a lot longer than we thought.
It is. But they are recovering. Microchips saw net sales grow 6% sequentially. They are past the bottom. They aren't seeing that rocket ship trajectory because their customers, industrial manufacturers, car companies, are still working through old inventory.
And NXP was similar.
Yeah. Very similar. They navigated a really tough first half of 2025. Now they're seeing sequential improvement across all end markets. So the recovery is happening. It's just that while the AI cloud is sprinting, the physical economy is jogging.
That is such a crucial distinction. It stops us from thinking tech is up or tech is down.
Right.
It really depends on which tech.
Exactly.
Okay, I want to get into the weeds. We've done the big picture. Now I want to do a lightning round.
Yeah.
Let's go company by company through this stack and pull out the specific aha moments, the details that really matter.
Let's do it.
We have to start with Amazon again. We mentioned the $200 billion spend, but what are they actually building? I usually think of AWS as a service that buys chips from NVIDIA or Intel, but their report says they're making their own.
This is the most critical pivot in the entire report. Their custom chips business is now a $10 billion annual run rate business.
$10 billion just from their own internal chips.
Yes. This is their Trainium chips for AI training and Graviton for CPUs. And it's growing triple-digit percentages year over year. They are not just a cloud provider anymore. They are a silicon powerhouse.
Wow.
And there was one detail that really showed the scale. Project Rainier.
Sounds like a spy movie. What is it?
It is the world's largest operational AI compute cluster. It uses over 500,000 Trainium 2 chips.
Hold on. 500,000 chips in one single cluster.
Correct.
For context, when we hear about these big supercomputers, aren't we usually talking about like 10 or 20,000 GPUs?
Exactly. A 20,000 GPU cluster is considered massive. 500,000 is a different species entirely. They're using it to train Anthropic's Claude model. This tells you Amazon is trying to break its dependency on NVIDIA. They're building their own ecosystem, vertically integrated from the sand to the software.
That explains the CapEx. They're building a fortress. Okay, let's pivot to the underdog, AMD. They've been fighting the heavyweights for decades. How do they hold up?
Better than holding up. They hit a record quarterly revenue of $10.3 billion, up 34% year over year.
That's huge.
But the interesting part wasn't just the revenue, it was the partnerships. They announced a massive deal with Cisco.
To do what?
To deploy 1 gigawatt of AI infrastructure by 2030.
A gigawatt. That's Back to the Future.
Yeah.
1.21 gigawatts. That's a nuclear power plant's worth of energy.
It is substantial. And it highlights a new constraint. It's not just about chips anymore. It's about power. A gigawatt deal tells you that enterprises are terrified of running out of electricity for these models.
And there was also a note about China sales in the AMD report. I thought there were bans on selling high-end chips to China.
There are, but AMD noted roughly $390 million in revenue from their MI308 GPU sales to China.
So they made a compliant version.
Yes. It shows they're still finding ways to service that market despite the regulatory environment. It is a tightrope walk, but $390 million is real money, and it proves the demand there is still voracious.
Okay, moving to Alphabet. We mentioned the $400 billion revenue milestone, but looking at the AI specifics, what jumped out at you?
The processing volume. Their models are now processing over 10 billion tokens per minute.
10 billion tokens a minute. I know a token is roughly a word or part of a word, so that's billions of words being generated and analyzed every 60 seconds.
It is the heartbeat of the modern internet. And the Gemini app has hit 750 million monthly active users. But financially, The real standout is Google Cloud. It's growing 48% year over year, hitting a $70 billion annualized run rate.
48% growth at a $70 billion scale it's usually impossible. The law of large numbers says you should slow down as you get bigger.
It sort of defies financial physics. It just confirms that the cloud transition is far from over. In fact, AI is kickstarting a whole second wave of migration.
Let's go back to Supermicro for a second. We talked about that jump to 12.7 billion. Is that just selling more servers? Or is the strategy changing?
It's about how they're selling them. They're focusing on data center building block solutions, or DCBBS.
Acronym alert. What is DCBBS?
Think of it as Lego for data centers, but the Legos are the size of refrigerators. They sell the entire setup, servers, storage, cooling, cabling, all pre-integrated.
So a company doesn't have to piece it all together themselves?
Exactly. Speed is the currency right now. If you can get a data center running 3 months faster than the competition, that is worth billions. Supermicro is capitalizing on that desperation for speed.
And they're expanding their customer base.
They are. From 4 large-scale data center customers to 6 to 8 in fiscal year 2026.
That doesn't sound like a lot of customers. 4 to 8.
It sounds small, but when each customer is spending billions, adding just 2 or 3 is massive. These are whales. We're talking about the biggest hyperscalers on the planet.
Right. Now back to Palantir. We talked about the rule of 40 being at 127, but what's driving that? Is it government contracts? Spy stuff?
Surprisingly, the growth engine is shifting. It's U.S. commercial revenue. That segment grew 137% year over year.
So that's the Main Street part of this. That's real American businesses buying their software.
Exactly. Palantir calls it operational leverage from AI, and they've coined this term commodity cognition.
Commodity cognition. Break that down for us.
Essentially, they believe that thinking cognition is becoming a commodity, like electricity. You can't buy it and inject it into your business operations. You need to optimize the supply chain. Inject cognition.
And it's clearly working. They issued guidance for 2026 revenue growth of 61%.
Very aggressive.
Okay, let's cool it down a bit with the joggers. Microchip and NXP. We talked about the gradual recovery, but were there any green shoots? Any signs of life?
Definitely. For Microchip, the key signal was inventory. They noted that customer requests for expedited shipments have increased significantly.
Ah, the rush order.
Exactly.
Yeah.
For the last year, customers were saying, don't send us anything, our warehouses are full. Now they're calling and saying, we need chips now. That is the classic sign that the inventory correction is ending.
And they had a tech announcement, too, something about a PCIe switch.
Yes, the industry's first 3-nanometer PCIe Gen 6 switch.
Okay, that sounds incredibly nerdy. Why does that matter to you, the listener?
It's the plumbing. You can have the fastest AI brain in the world, the GPU, but the nervous system, the switch, can't move data fast enough. The brain just sits idle.
Yeah.
PCIe Gen 6 is a massive upgrade in speed.
So even though Microchip is seen as an industrial player, they're making the high-speed plumbing for AI.
They are. And NXP, their play is fascinating because they're distinguishing between generative AI, the ChatGPT stuff, and physical AI.
Physical AI.
Robots, software-defined vehicles, smart factories. NXP is betting that the next wave isn't just chatbots writing poems, but machines moving in the real world.
So the brain gets upgraded first generative AI, then the body gets upgraded second physical AI.
That is the thesis. And they seem content to wait for that wave, stabilizing their business in the meantime.
Okay, so we have all these data points. 200 billion CapEx, 127%, rule of 40, gigawatt partnerships. Let's try to connect the dots. What are the patterns here?
The first pattern is undeniable. It's the shift to custom silicon.
It's not just about buying chips anymore. It's about making them.
That's a huge structural shift. Amazon's Trainium success, AMD's custom platforms. It shows the biggest players are moving away from generic, off-the-shelf hardware. They want custom silicon tailored exactly to their models. It's becoming a bespoke industry.
And the second pattern?
The two-speed economy. The divide is just. It's stark. On one side, you have the cloud and AI training companies, Amazon, Google, Supermicro, AMD. They were in hyper-growth mode.
And on the other side,
You have the embedded and edge players, Microchip, NXP. They're in a stabilization phase. They're waiting for that physical AI wave to catch up to the generative AI wave.
So if you're listening to this, you're seeing a two-stage rocket. Stage 1 is the data center. Stage 2 is the car and the factory.
Precisely. And right now, stage 1 is burning all the fuel.
Which brings us to the iron takeaway. We always like to close with the management outlook. Looking at 2026, what's the mood?
Aggressively optimistic for the giants, but not without risks. There are mentions of supply chain constraints, specifically around memory bandwidth. You can't build these clusters if you can't get the high bandwidth memory.
Right.
But overall, the mood is that this is a long-term shift, not a bubble.
If you had to pick one metric, just one number from this entire earnings season to write on a sticky note and put on your monitor, what is it?
It has to be Amazon's $200 billion CapEx projection.
Why that one? Why not Palantir's growth?
Because money talks. You can have all the hype and marketing slides you want, but when a company as disciplined as Amazon, a company famous for counting every paperclip, commits $200 billion in hard cash, it signals that they believe this infrastructure is the new foundation of the global economy.
They're betting the company on it. A vote of confidence with 11 zeros behind it.
It is. But I have to give an honorable mention to Palantir's 127% Rule of 40 score.
Because it just breaks the math.
Because it shows that once software actually starts working for AI, once that commodity cognition kicks in, the profitability potential is absurd. It is efficient growth on steroids. It hints at what the future balance sheets of these companies might look like once the infrastructure is built.
So here's the final provocative thought for you to chew on. We have Amazon projecting $200 billion in spending. We have Palantir growing U.S. commercial revenue at 137%. The question is, are we witnessing the peak of this investment cycle? Is this the top? Or, as Amazon suggests with their roadmap talking about Trainium 4 delivering in 2027, is this just the warm-up lap?
If Trainium 4 is already on the roadmap for 2027, they're planning for a decade of this, not a year.
Yeah.
They are treating this as the new normal.
That is a scary and exciting thought. Keep an eye on those physical AI companies, NXP and Microchip. If the cloud giants are the sprinters, the edge players might be drafting right behind them for the next leg of the race.
It will be fascinating to watch the baton pass from the cloud to the edge.
Thanks for diving in with us. We'll catch you on the next one.